Welcome to this week's series of Credent Connect. And today we're going to focus predominantly on the equity market volatility, right? The ups and downs, the swings of the stock market, not only here in the US, but also globally. Before we do that, let's take just a step back historically here, very recent history, and kind of gauge what happened. During the depths of COVID, consumers in general, you, me, your neighbors, we had this notion of pent-up demand, right? Both savings-wise and pent-up demand for goods and services that we couldn't actually spend on, right? That consumption backdrop was hindered by the global pandemic. As COVID opened up, right, that pent-up demand surged to the upside, overshooting the normal trend. So we surged to the downside of demand during COVID, then we surged to the upside trend past COVID. Since that time frame, the economy has started to normalize back to its normal long-term trend. The normalization cycle, however, aside from just consumption in the economy, has also transpired normalization in the equity market with overall stocks and their return profiles. Simultaneously within that recovery and the normalization, a small handful of names of stocks, mainly large cap technology names, dominated the concentration of risk and return profile of the markets, and as a result, kind of generated some tremendous gains along the way. Fast forward to where we're at today, and some of the catalysts of downside volatility in the equity markets that were largely spurred, and kind of the catalyst here recently was an interest rate hike by the Bank of Japan here over the past couple of days. That has spurred this notion that things are slowing down. To spur the notion that the economy may be leaning towards a recession. The reality is the Federal Reserve has generated an intentional approach to slowing down the economy. We have talked about this continuously over the past couple of years now to some degree. What we're seeing today are some of the lagged intentional effects of the Federal Reserve to try to bring the economy down back to its normal trend, its long-term trend cycle. What we're seeing there transpire from the market side is these big overvalued names are now starting to generate some volatility during this normalization of this economic backdrop, okay? And because indices are so biased to just these few concentrated names, when they are volatile, the whole market appears volatile. So this perception of volatility is reality for a lot of indices, yet for a lot of individual portfolios and overall strategies and how we manage underlying assets here at Credent Wealth Management, the risk management backdrop of how we've gotten to this point, how we've managed those portfolios over the past 12 to 18 months, has allowed us to not participate in such a concentrated backdrop of those portfolios, which results in a notably better risk management outcome for our clients during times of volatility. That has also occurred on the backdrop that no one can time the market. Despite this perception, this belief that we can time the market, it is quite impossible. Therefore, using the data along the way and being very intentional in the risk backdrop helps tremendously. But for those that do and think they can time the market, the worst outcome there is failure to ever get back in the market with that perception that they can actually know when to jump back in with 2 feet, right? Getting out is one thing. Knowing when to get back in and doing it accurately, not missing the initial recovery stages, that can be a notably more detrimental component than just staying invested during this whole time. And a quick note on the US consumer from a kind of fundamental and fiscal health standpoint. We have seen the labor market actually tighten a little bit. And what that means is there were more open jobs. Now there are less open jobs in the economy. The unemployment rate has gone from that 3% mark up to that 4.3%. To put that in perspective, 4.3% unemployment is a very, very healthy level of unemployment relative to total employment in the United States. The Federal Reserve still maintains that 5% as the natural level of unemployment, yet we are continuously below that, despite having gradually moved up to 4.3%. Relative to something like the global financial crisis in 2008, where unemployment hit double digits, where the labor market and the consumption backdrop was dismal, where credit profiles, meaning credit card debt and delinquencies on home payments, mortgages, credit cards, and things of that nature, where those skyrocketed. We are in a completely different structural backdrop today than we were back then, to the point where it's not even a relative fair comparison. So as you hear things in the media that unemployment rate is now, the highest in the past 2.5 years and things like that, and those will continue, by the way, because that was the Federal Reserve's intended nature to slow down the economy. Those figures have to be compared to what we reference as absolute values. This absolute value compared to this really bad one over here, despite having ridden the wave up to current levels. So consumers remain healthy on a broader basis. Relative comparisons to times in history where consumers were in a very dismal spot, those aren't even close to today. When we look at that as a propensity to consume for consumers over the next 12 to 18 months, when we look at what may transpire from the Federal Reserve with their interest rate policy in actually lowering interest rates, how that may transpire to the housing market, and how that may bleed into more spending and more revenue for a lot of companies, the backdrop is notably more positive than the gloomy backdrop that is perceived based on broad macroeconomic data. So as we think about the long term, as we think about how the current structures of how we're positioned in a very healthy, downside protected manner, we feel very comfortable, we feel very excited for equity market participation over the next 12 to 18 months, because we truly believe what's happening right now and the normalization of that trend, that long-term demand trend, right? What's happening today is that base for the next secular growth cycle. And we truly fundamentally believe that as that occurs, the rotation also will occur out of these mega cap tech stocks to a more normalized market cycle where potentially the average return of a stock in the S&P 500 may actually be more than that of just a few names that are concentrated at the top of the index.